And on top of regional growth, copper also has a significant role to play in the energy transition space, given the growing structural pressures to reduce emissions and switch to cleaner energy sources.
Hello, and welcome to another one-to-one mining investment APAC online content session. Today, we have Hun Hao Chuah, Senior Analyst for Global Copper Mine Costs at Mackenzie, here to give us the outlook on copper.
Thank you for the introduction, Amy. Hello, everyone, and thank you for listening to our copper presentation today. My name is Hun Hao Chuah. I'm a Senior Research Analyst at Mackenzie within the Metals and Mining Research with focus on global copper mine costs. The WoodMac Copper team is a global team devoted to research on the entire copper value chain. Our coverage spans from analysis of mine projects to mine production, including both SX-EW and copper concentrate, the flow of copper concentrate to smelters and refineries, as well as scrap supply and dynamics on the supply side. And on the demand side, we have the analysis of first use of refined copper and end-use copper consumption. It is very much from this position and combined with the wider WoodMac, oil and gas, power and renewables, and energy transition teams that we form a holistic view of the copper market. And for today's presentation, the focus today will be on the drivers that will shape the outlook for copper, as well as copper role in the energy transition and global decarbonization story, both from a demand and supply perspective. We have titled today's presentation, How Long Will It Take to Return to a New Normal? You may ask, why this title? Well, copper price has reached decade high level of more than $9,600 per ton since 2011. And in the absence of a major economic downturn, current high prices should support further investment in mining projects. And for those diversified miners that have a cross-commodity capital allocation decisions to make, we believe mining companies will continue to advance scoping and feasibility studies, buoyed by optimism around a copper-intensive green recovery. And the question is, how long will the upside be maintained? Well, firstly, let's have a brief review of what has happened in the past year. So if we look at the left-hand side chart, the light blue line shows the copper price in US dollar per pound. The dark blue bars are the end of the quarter CFTC net managed money position, and the shaded area being the annual market balance. If you look back at the last 5 years, the market surplus is generally matched by a price fall, with the price recovery as the market moves into deficit and works off excess stocks. So while WoodMac forecasts price on the basis of supply and demand fundamentals of the copper market, there are times when there are other more prominent factors in the price formation. And over 2020, you will see the market supplies indicated by the shaded area. At the same time of a resurgence of net managed money position in copper, and a copper price that actually continued to climb. So why the return in interest and buying into copper, especially at a time of an oversupplied market? And really based on fundamentals, prices should have fallen back. One reason we have noticed was the continuing reports of mine supply disruptions, as indicated in the top right-hand side chart. Mine supply disruptions are now approaching 5.3% of initial production expectation for 2020. However, there could be further additions to the total as we continue to distill year-end figures in the coming months. Close to 3% of the disruption is attributed to COVID-19, mainly occurring in Q2 2020, and close to 60% of last year's disruptions occurred in Latin America. Other contributions to mine disruptions happened as operations started up again in Q3 2020 and into the last quarter as well. There was escalation of strike activity in Chile and rising political tension in Peru. And in Chile, a combination of high copper price and a change in shift patterns due to COVID-19 restrictions have supported unions in seeking improved terms in contract negotiations. Another reason for the resurgence in fund interest was China. The rapid recovery in Chinese copper demand on the back of the government announced stimulus and commitment to invest in copper-intensive infrastructure of 5G stations and EV charging, as well as subsidy plans on autos and home appliance. And those are the two end-use sectors which were the hardest hits during COVID-19. And again, many investors in today's metals markets seem to be betting on higher prices. They're anticipating that a combination of consumer spending together with government stimulus and rising business investment, those will result in an accelerated recovery. The larger macro funds are playing the long game, well, given the push for decarbonization and energy transition. And they are of the opinion that this will lead to a sustained period of robust demand growth. So this does mean that we have started 2021 in what Wood sees as a precarious position. And no doubt, this will lead to another year of unpredictable prices. So as we first turn our attention to the demand side of the copper market, on the left-hand side chart, we can see total copper consumption index to 2018. And that was the last year there was an increase in copper consumption before the pandemic hit demand last year. There was a slight decline in copper consumption in 2019, mainly due to geopolitical tensions, as well as a struggling global manufacturing sector. So as such, there was much hope at the start of 2020 that there would be a recovery in demand. But as we now know, that was not the case at all. So while Chinese refined growth exceeded expectations due to a couple of reasons, being earlier than expected return to normal of the Chinese economy, higher stimulus to boost economy, as well as higher consumption in refined metal due to tightness in the scrap availability. Besides that, there was little growth on a total consumption basis, as shown in the chart. On a global basis in 2020, total copper consumption actually fell by over 4%. And the recent developments around the COVID-19 vaccines are rendering cautious optimism. We are now forecasting an acceleration in total copper consumption by 4.1% and 3.7% respectively in 2021 and 2022. And this is supported by stimulus measures. Total copper consumption will expand by an average annual growth rate of around 3% from 2020 to 2025. And industrial migration away from China and supply chain regionalization is really what's pushing that emerging Asia increase in demand. It was a trend that initiated with the US-China trade war, and that has been exacerbated by the pandemic. And while North America may reap marginal benefits from reshoring, ASEAN countries are expected to be the primary beneficiaries, especially following the signing of the Regional Comprehensive Economic Partnership, RCEP, between the Asia-Pacific nations. Well, new semi plants in Europe, the US, and Russia, and across Asia will underpin demand over the medium term as well. So as we switch our attention to demand over the longer term, what will actually underpin future growth over the next decade or two? From a regional perspective, the real growth story is Southeast Asia and India, as can be seen again from left-hand side chart, and really taking over from China. A fundamental driver of copper demand in India and Southeast Asia is urbanization and industrialization of these developing economies. And on top of regional growth, copper also has a significant role to play in the energy transition space, given the growing structural pressures to reduce emissions and switch to cleaner energy sources. Now, what we have done in the chart on the right-hand side is that we set out how demand for copper would evolve as the energy transition progresses over the next 20 years. The dark blue bars indicates total copper demand related to the energy transition under our base case. The light blue bar shows the energy transition of 2-degree scenario, and the light gray is non-energy transition demand. Under the 2-degree scenario, copper gains additional offtake from energy storage and transmission, and also distribution of the electricity build-up. And if the 2-degree path is taken, the energy transition could well account for 50% of copper demand by 2040. So what does achievement of carbon neutral means for copper? Well, it means a much higher rate of electrification, a higher share of renewable power, and more EVs on the road throughout the world. Now, the Chinese government has released the Energy Saving and New Energy Vehicle Technology Roadmap 2.0. The plan outlines the concrete goals of transforming Chinese automotive industries into a wholly electric industry by 2035, when pure combustion engines will no longer be permitted. This presents upside risks for copper demand in China, as they aim to become carbon neutral by 2060. Now, the key question is when this might emerge. Woodmac's electric vehicle team has recently revised up our EV forecast in Q4 last year. Our in-house view is that the roadmap TRIP 2.0 will lead to higher penetration of EVs, but the targets in the roadmap will be hard to achieve. Again, the Chinese government also has not given the breakdown of the fleet composition for the strategy outline, but we will continue to watch the space. On the other hand, Woodmac's Power and Renewables team forecasts that achieving carbon neutrality by 2060 will lead to higher power demand. For instance, the industrial sector is largely run on natural gas and coal consumption. And if the carbon neutral goal is to be achieved, there will need to be a move to electrification. And that electricity needs to come from renewable sources or sources that do not have high carbon emissions. In overall, the increased demand for electricity as China continues to upgrade its infrastructure, the grid infrastructure, it will help to support copper demand. And now, moving on to the supply side and mine project development delivering growth in supply. It is worth noting that a significant proportion of near-term supply growth is at an advanced stage of development. Supply growth from new greenfield projects is close to completion. On the left-hand side chart, we have the annual additions to global mine production capability before disruption allowance. 2 million tons of the near-term growth will come from 10 greenfield projects, each of them with more than 100 kilotons per annum of copper production capability, which are shown on the right-hand side chart. And over the next 5 years, top 10 largest greenfield projects will add 2 million tons per annum of copper, which is over half of the total cumulative additions to supply. And of these projects, 2 projects are already in production and ramping up. These 2 projects are Cobre Panama and Mirador. A further 4 projects are due to commission next year, and they are Kamoa-Kakula, Spence, Shillong, and Timok. And the remainder projects of Quellaveco, Quebrada Blanca, Yudokan, and Mina Justa, they should be commissioned by the end of 2022. With a significant amount of capital already sunk on these projects and priced where they currently are, we believe the risk of cancellation or delay is relatively low. Factors that could affect the growth outlook include technical issues on startup leading to slower than expected ramp up and the ongoing risks associated with COVID-19. However, since the height of containment measures in Q2, Q3 2020, mine supply has recovered well at most of these affected mines. With different vaccines being approved, we believe the risk of further widespread pandemic-related disruption to have been mitigated. We continue to monitor the activity on the ground as much as possible with our analysts based in Peru. And on the brownfield expansion projects, much of the remaining growth in mine supply will rely on the delivery of a few sizable brownfield projects, all of them currently under development. 4 projects are expected to add close to 1.2 million tons of copper by 2025, and they are Grasberg Block Cave, Oyu Tolgoi Underground, Decarbonization Mashamba, and El Malik. And of these projects, Grasberg is already well underway and ramping up, whereas production at Decarbonization Mashamba should start to ramp up by the end of 2021 with expansion of the concentrator lifting production. Now, climate change and industry's role in the decarbonization movement is rising to the top of agendas amongst investors and producers. And with increasing requirements of environmental and emissions reporting, companies are now getting scrutinized for perceived lack of commitment towards reducing carbon emissions. Several major producers have set longer-term emissions reduction target in the past year. So before we go into decarbonization options and progress of copper miners, let us first look at the driving factor of energy use in copper mines. Now, mining is an energy-intensive industry. Power and diesel consumption serve as the two main contributors to direct emissions on site. As you can see from the left-hand side chart, process grades at both mill and heap leach operation have been falling for the past 2 decades. And under sustained higher copper price, grade declines are expected to continue as low-grade material are deemed economic under higher copper price. So as head grade fall, miners must now mine and process more ore tonnage to produce and satisfy the increasing demand of copper metal, requiring more power to do so. So as ore bodies deplete and with incentive of higher copper price, miners will move to develop projects which are in remote location and deeper ore body with lower grade. With the added transportation distance and tonnage mined, more energy will be required for mining and processing. And on the right-hand side chart, this chart shows the power and diesel cost proportion of total mine site production costs. Power costs are often more than 10% of copper mine site production costs, whereas diesel can take up to 11% of production costs. Diesel and power costs in the two bigger copper producing countries accounts for around 5% to 15% respectively of the mine site production costs. So, but of course, energy intensities tend to vary across jurisdictions, locations, mining method, as well as processing technology to achieve optimal recovery. So what are miners doing to actually decarbonize? One of the options to decarbonize is to move to renewable energy sources. Miners have made moves to secure procurements with renewable energy sources in the past year, with the largest procurements actually signed by multinational miners. The contracted capacity includes renewable projects from both grid-connected and off-grid solar, wind and hydro plants, as well as renewable systems currently under development. Chilean copper sector carries the majority of the procured renewable capacity through to year 2025. On the left-hand side chart, we can see that Chilean mines will buy power from just over 6.1 gigawatts of installed renewables by 2025. The country currently has 4.9 gigawatts of total project pipeline, including 3.5 gigawatts of projects from two companies set to be completed in 2021. And this will cause a massive surge in cumulative installed capacity expected next year. Post-2025, there will be limited opportunity for renewable developers in Chile's mining sector, as the market will be quite heavily saturated. In 2020, 63% of Chile's mine sites have procured renewables, and they are mostly development stage assets. And we expect 90% of Chile's mine sites to have installed renewables by 2025. Tracked renewable pipeline capacity by development status is shown in the right-hand side chart. And other options which miners are considering to advance the decarbonization movement include displacing diesel consumption in the mining operation. Miners are looking at increased electrification of mining fleets and potentially increasing adoption of conveyors as well, where feasible. We have actually written an insight on the review of technology to improve both the sustainability and economics of copper mining. And now, moving on to our last slide, I have a look at the outlook of copper price. Higher prices have encouraged continued investment in supply. Over 3 million tons of annualized production has been committed since 2017. And this is highlighted in the blue bubbles on the right-hand side with an overview of the number of projects and production capability. Most of this volume is expected in the next 3 or 4 years, and some, as mentioned, is already in production. So despite robust mine supply growth of 3% in 2021, and this has included considerations of disruptions, we expect the recovery in demand to keep the market finely balanced this year. hitting the elevated spot copper price that we have currently, we have actually revised and raised our annual average copper price for this year. From a fundamental perspective, we would expect prices to begin to trend lower from the latter half of this year. So while the copper price will find intermittent support on the risk of slower than expected project ramp-ups, as well as upcoming elections and labor negotiations in Peru and Chile, respectively, we do not anticipate any fundamentally based significant shift higher from the current trading levels. In anticipation of above average mine supply growth in 2022 and 2023, and also an increased contribution of secondary material, we do expect price to come under pressure as mine supply growth exceeds consumption and stocks starts to build. The market is expected to register a metal surplus of close to 600 KD in 2023, building up from the current inventory level. So although additional capability from new projects into our base case has lifted demand production forecast, new supply still needs to be sanctioned if it is to keep pace with longer term demand. And given the lead times required to bring new mines into production, mining companies will still need to continue to bring projects through the development pipeline. And this current period of strong cash flow is a window opportunity for the industry to play catch up and to build in a pipeline to meet longer term requirements. So to end up the presentation, I guess just to reiterate some key takeaways from the presentation. So although we expect global demand to recover, near-term strong supply growth is set to weigh on prices. Longer-term copper demand growth is supported by the trend towards decarbonization and energy transition. Risks to our longer-term demand view include substitution and thrifting of copper, which was not addressed in this presentation. And this risk is dependent on price, but also sustainability of competing raw materials. And lastly, new mining projects are still required to meet future demand for copper, but scrap supply is a risk on the requirement for mine production. Project quality is a hurdle with low grades, high capital and operating costs, and a move by producers to continue to reduce their carbon emissions. So that really is the message I will wrap up the presentation with. Here's my contact details. If there are any area of interest of which you would like to have further discussion, please feel free to contact us. Otherwise, thank you again for listening to the presentation.